Most gold and silver investors believe they are prepared for the future. They believe they own safety. They believe they own protection. But by 2026, many of them will be wiped out. Not because gold fails, not because silver disappears, but because they misunderstood how these metals actually work. The danger is not the asset. The danger is the strategy. This is the story of why most precious metal investors lose money and how to make sure you are not one of them. Gold and silver have survived for thousands of years. Empires collapsed, currencies vanished, governments failed. Through it all, precious metals remained. That history creates confidence, and confidence creates belief. But belief is not the same as understanding. Most modern investors buy gold and silver for the wrong reasons, at the wrong time, in the wrong form, and with the wrong expectations. They believe owning metal automatically equals protection. It does not. Gold and silver are not magical shields. They are tools. And like any tool, they only work when used correctly. In the years leading up to 2026, fear will drive massive demand, inflation, anxiety, debt concerns, currency instability, geopolitical tension. Every cycle creates the same reaction. Investors rush into metals late, emotionally, and without a plan. That is how losses begin. One of the biggest mistakes is confusing long-term preservation with short-term speculation. Gold does not move the way stocks move. It does not produce income. It does not compound. Its value comes from stability over time, not explosive growth. When investors expect fast gains, they over-leverage. They buy miners instead of metal. They use futures instead of ownership. They chase momentum instead of structure. That turns protection into risk. Another mistake is buying paper gold instead of real exposure. Many investors believe ETFs give them safety. What they actually own is a promise, a claim, a structure built on liquidity and counterparty trust. In calm markets, paper works. In stress, it breaks. When volatility spikes, spreads widen, redemptions freeze, physical delivery becomes impossible. Investors learn too late that they never owned what they thought they owned. Silver carries its own trap. Silver is more volatile than gold. It is thinner, more emotional, and more speculative. In bull markets, it surges. In downturns, it collapses faster. Many investors buy silver expecting gold-like stability. They get stock-like swings instead. That mismatch destroys confidence. Timing matters more than most people admit. Buying gold after it has already surged feels safe. It is not. It is crowded. By the time headlines turn bullish, smart money is already positioned. Late buyers become exit liquidity. This pattern repeats every cycle, every single time. There's also the storage illusion. Investors assume owning physical metal solves everything, but storage costs matter, liquidity matters, access matters. Selling during stress is harder than buying during fear. If you cannot sell efficiently, protection turns into a trap. The final mistake is emotional ownership. Investors attach identity to gold. They see it as rebellion, insurance, or certainty. That emotional bond makes rational decisions impossible. They refuse to rebalance. They refuse to exit. They refuse to adapt. Markets punish rigidity. So what happens by 2026? Debt continues to grow, rates fluctuate, volatility increases, governments adjust policy, markets rotate. In that environment, gold and silver will move sharply, but not always in the direction investors expect. Those who chased fear will panic. Those who over-leveraged will be forced out. Those who misunderstood liquidity will be stuck. This is how investors get wiped out without gold ever failing. So how do you avoid becoming one of them? First, understand purpose. Gold is insurance, not a lottery ticket. It protects purchasing power over time. It does not promise excitement. Second, understand structure. Physical ownership matters. Counterparty risk matters. Liquidity matters. Know what you own and how you can exit. Third, understand allocation. Precious metals should balance a portfolio, not dominate it. Concentration increases risk, not safety. Fourth, understand cycles. Buy before fear peaks. Reduce exposure when narratives turn extreme. Discipline beats conviction. The investors who survive are not the loudest. They are the calmest. They treat gold and silver as part of a system, not a belief. They adjust as conditions change. They respect history without worshiping it. Gold and silver will still exist in 2026. They will still matter. But many investors will not survive the journey because they confused ownership with understanding. The metals are not the problem. The mindset is. If you want clear thinking in a world driven by fear, real history instead of headlines, and financial stories that explain why, not just what, you're in the right place. This is The Financial Story. Subscribe and learn how money really moved the world.